Imagine this happening on a normal trading morning. 9:30 a.m. The exchange hits a major bank with a simple demand. Post $4 billion in marning. Immediately. Not next week, not we'll roll it, right now. And then the clock starts. 10 a.m. No confirmation. 10:30 a.m. Still nothing. By 11:08 a.m., the only thing louder than the silver chart is the rumor. They didn't make the call. That's the event. A margin demand allegedly went unanswered long enough that the street started whispering the word nobody wants to say out loud. Default. You're here with us. Let's talk like adults. First, understand what a margin call really is. It's not a warning. It's the exchange saying, your losses are eating the safety deposit. Refill it or we liquidate you. Leverage is a loan made out of trust. Margin is the collateral that keeps that trust alive. And when price moves against you, the exchange doesn't debate your thesis. It demands cash. Cash is the only language it accepts. So the question that should hit you in the chest is this. How does a $1 trillion bank struggle to produce $4 billion on command? Because assets and cash are not the same animal. A bank can own oceans of bonds, towers of real estate, and mountains of paper profit, and still be cash poor when the bill is due at lunch. That's fractional reserve in one sentence. They don't hold your money in a vault. They run a flow machine. Most days the flow works. In stress, the flow snaps. Now let's make the margin call visual, because if we don't feel it, we underestimate it. Margin is like the security deposit on an apartment. You move in with a deposit because the landlord trusts you. If you start smashing walls, the landlord doesn't wait for your comeback. He demands more deposit, or you're out. A short in a ripping market is a sledgehammer. And this is where people get fooled. A bank can look calm while it bleeds, because losses don't always show up as a headline. They show up as collateral demands behind the curtain. That's why the margin clerk matters more than the talking head. Now, why does $4 billion hit like a punch? $4 billion doesn't automatically mean insolvent. It means short liquid cash at the exact wrong moment. A liquidity pinch. Giants stumble on liquidity pinches because banks don't keep mountains of idle cash. Idle cash earns nothing. So they park money in safe assets like long-dated bonds. But when rates rise, bond prices fall. So the safe asset becomes a locked drawer with a shrinking number written on it. That's the liquidity trap. Your assets exist, but they don't turn into cash fast enough without taking a brutal haircut. So if you need billions in an hour, you either sell into a falling market or borrow cash from someone who still trusts you. And that brings us right back to trust. Trust is the real currency of the banking system. The moment trust wobbles, lenders demand more collateral. More collateral drains cash. Drained cash forces selling. Selling pushes prices lower. Lower prices trigger more calls. Same loop, different mask. Now, why does silver keep showing up in these nightmares? Because silver is a tiny door in a crowded building. Most markets are wide hallways. Silver is a narrow staircase. There isn't enough depth for a giant to exit quietly when price runs. A short can manage risk when volatility is small. When volatility explodes, the trade becomes a hostage situation. And remember, paper silver is enormous compared to deliverable physical metal. Futures are promises. Options are promises on promises. The actual bars that can be delivered on demand, that pile is not infinite. So in real squeezes, you get a strange split. Spot prints one number, physical premiums scream another. Charts say weak, dealers say sold out. That gap is reality leaking out. They want you staring at the paper ticker. They want you hypnotized by a number that can be pushed with contracts. Because while you stare, the real game is inventory and settlement. Now watch the clearinghouse mechanics in this scenario. When volatility rises, margin rises. When margin rises, leverage shrinks. When leverage shrinks, forced selling appears. So even traders who have nothing to do with silver can get hit. They sell equities, they sell credit, they sell anything liquid to raise collateral. That's how a metal story becomes a whole market story. Now, a psychological warning, because squeezes are warfare. They will whipsaw price. Up 5, down 4, up 7, down 6. They want motion sickness. They want you exhausted. They want you to dump your position just to feel relief. So we don't stare at every tick. We watch settlement. We watch whether forced buying keeps returning. And we size risk so we can survive the noise. Because survival beats bravado. One more hard truth. In stress, the fine print becomes a weapon. Extraordinary circumstances is the phrase they use right before they rewrite the deal. Know what you own before the rules start moving. And here's the policy trap nobody likes to admit. If officials step in fast, they can stop the liquidation spiral. But fast intervention signals weakness. Markets read it as the pipes needed help. If officials wait, the spiral can run on autopilot. Liquidations force price spikes. Price spikes force more margin. More margin forces more liquidations. By the time they speak, the damage is already priced. So they choose speed over elegance. They open emergency lending windows. They loosen collateral rules. They call it temporary. Temporary has a habit of sticking. And if new liquidity gets created to save the casino, that liquidity doesn't vanish. It floats through the system looking for shelter. Cash for a week, hard assets for years. So if the rescue comes, don't just watch silver. Watch the dollar's reaction. Watch bond yields. Watch credit spreads. Those are the lie detectors in real time today. Now watch the trap that makes silver so dangerous for shorts. Silver isn't just a commodity. It's a tiny market with an outsized role. When paper positioning gets too big, it becomes a spring. Push it too far and it doesn't drift back. It snaps back in your face. If a giant is short and silver rips higher, losses don't rise gently. They compound. And the exchange doesn't care who you are. If you miss, rules kick in. Here's what the rulebook says in plain English. If you don't pay, the exchange takes the position and starts closing it for you. Closing a short means buying. Buying means bids. And forced bids don't negotiate. That's why a missed margin call, if it's real, turns into fuel. It creates a buyer that must buy, no matter the price. This is how squeezes go vertical. Now, we need to be honest about certainty, because the internet loves to declare things confirmed before the paperwork exists. Fact. In any leveraged market, margin demands happen when volatility spikes. Fact. If a member fails to meet margin, the clearing process can escalate quickly. What's uncertain? Whether the rumor is accurate, how big the exposure is, and what backstops are already in motion. So we treat this as a stress test story. Educational, not a prophecy. We manage risk. But even as a scenario, it exposes something most people don't want to face. The system doesn't break because it's evil. It breaks because it's tight. It's built like a high-speed highway with no shoulder. Everything works until one truck jackknifes. A margin event is that truck. Now look at the second-order effect, contagion. A major bank isn't just a bank. It's a counterparty web. It's the other side of trades for other banks. It's a custodian for massive funds. It's a daily source of short-term funding and settlement. So when a giant looks stressed, everyone starts asking the same question. Do we still trust them overnight? That's where the repo market comes in. Repo is the oxygen line. Cash for collateral. Every night, institutions borrow short to fund long. When trust is high, repo is boring. When trust breaks, repo becomes a panic button. Rates jump, haircuts widen, lenders pull back, and suddenly the whole street starts hoarding cash like it's water in a blackout. Ask yourself, if you're a treasurer today, do you lend to a rumor, or do you lock the doors and count your cash? Exactly. And here's the cruel part. When institutions hoard cash, they create the very illiquidity they fear. So the spiral feeds itself. Now, watch how it hits the stock market. When a bank or fund gets a margin problem, it doesn't sell what's down. It sells what it can. It sells the winners. It sells the liquid names. It sells to raise cash before someone raises the haircut again. That's why you can see a broad market crash with no obvious headline. The headline is collateral. The market isn't pricing growth, it's pricing survival. Now let's pull the camera back to silver again, because this is where the pressure cooker whistles. If the exchange liquidates a stressed short, the first wave is futures buying. Then options kick in. Dealers who are short gamma get forced to buy as price rises. That's not ideology, that's math. Price up forces hedging buy. Hedging buy forces price up. And suddenly the chart looks like an elevator with cut cables. This is why people wake up and say, how did it move $10? Because the buyer wasn't a human. It was an obligation. Now, here's the line you need to burn into your mind. In a squeeze, price is not set by opinion. Price is set by urgency. Urgency is brutal. Urgency is blind. Urgency doesn't care about fair value. It cares about closing the hole before it becomes a crater. So while media panels argue about narratives, the street hunts for one thing. Who has to buy? And if the rumor is even half true, the answer is somebody big. Now let's talk about what the authorities do in this scenario, because this is where the story turns from trade to currency. If a major member is stressed, policymakers face two doors. Door 1, let it fail and risk a chain reaction through counterparties and clearinghouses. Door 2, inject liquidity fast enough to stop the panic. Door 2 sounds clean. It isn't. Liquidity injections are printing with better branding. They expand balance sheets. They dilute the unit. So if the system gets rescued, the currency pays the invoice. That's not politics. That's plumbing. Here's a question that forces thinking. If they print to save the casino, what happens to anything priced in that currency? Exactly. Hard assets reprice. Not because we love metals, because the yardstick shrinks. This is why silver can rip from two angles at once: forced buying from a short unwind and loss of confidence in the paper unit. Now, let's make this personal, because viewers don't live inside Bloomberg terminals. A deposit is not a physical pile of bills. It's a claim. It's a promise. And in a crisis, promises get rewritten. There are legal frameworks where large deposits can be restricted, converted, or delayed in a resolution. Call it a bail-in. Call it stabilization. Call it temporary measures. The effect is the same. Access can change. We're not telling anyone to panic. We're telling you to understand the game you're in. If we're wrong, where will it show first? Not in speeches, in friction, transfer delays, withdrawal limits, apps that need maintenance, phones that ring forever, small frictions or smoke. Now, another thing people miss: narratives. If markets start shaking, the public wants a villain. Officials want a villain even more. So don't be shocked if they blame speculators, or online communities, or foreign actors. Because blaming leverage is inconvenient. Blaming bad risk management is embarrassing. Blaming policy is dangerous. So they aim the spotlight away from the plumbing. And if metals move hard, you may hear calls for restrictions, reporting, limits, taxes, rules. When confidence breaks, control expands. Now, let's keep our own house clean. This is educational. We size positions like professionals. We don't bet rent money on a headline. We don't chase candles because they look exciting. We measure. But we also don't ignore the lesson this scenario screams. When leverage meets volatility, the clock wins. Now, here's the next open loop. This is where the real drama sits. If silver is ripping because of forced covering, what happens to paper claims on silver? Because paper is a promise to deliver later. And in stress, later becomes negotiable. This is where exchanges and brokers reach for legal language like force majeure, cash settlement, rule changes, extraordinary conditions. They will say it's to protect the market, but it protects the side that can't deliver. So we need to know what we hold. Allocated metal with clear title is one world. Unallocated IOUs are another. In calm times, they look similar. In stress, they separate. Now watch the street's behavior, because it tells you more than any anchor. If the rumor spreads, funds will front-run the forced buyer. They'll buy silver now to sell to the covering flow later. That's not morality, that's predation. It accelerates the move. And the more it accelerates, the more margin it demands from remaining shorts, which forces more covering, which accelerates again. That's the squeeze loop. Here's another question for the comments. If silver rips on forced buying, do you think exchanges will honor delivery the same way, or will they push cash settlement? Drop your take below. We want the smartest debate, not the loudest. And quick CTA, if you want the next update when the next domino falls, subscribe now. Short, simple, done. Back to the scenario. If the rumor is wrong, markets calm, volatility fades, and silver settles. That's the downside case. If the rumor is right, the next 24 to 72 hours become a battle over trust. Trust between banks, trust in clearinghouses, trust in currency. And trust is fragile. Once cracked, it doesn't snap back. It leaks. So what do we watch without getting hypnotized by the candle? We watch verbs, not adjectives. Emergency facilities, unscheduled meetings, spiking overnight rates, trading halts, technical issues that suddenly appear in payment rails. Those are the tells. Because if everything is fine, nobody needs to keep telling you it's fine. Now, let's end where the fear actually lives. The moment the public notices. Professionals move first. They always do. The public moves when access changes, when withdrawals are capped, when transfers stall, when a temporary rule shows up. That's when bank lines form. That's when headlines get real. That's when it stops being a market story and becomes a street story. So here's the cliffhanger. If today's margin rumor is the first crack, then the next crack is the response. Do they admit stress and inject liquidity openly, or do they patch it quietly and pretend nothing happened? Either way, the signal is the same. The system needed help. So I'll ask you one final question, and I want you to answer it honestly in the comments. If you had to watch one warning light tonight, what would it be? ATM limits? Funding rates? Trading halts? Or the sudden, "Don't worry" press conference? Stay sharp, stay calm, and keep your plan ready. Because if the clock really started at 9:30 a.m., the next headline won't be about silver. It'll be about whether the market can survive the price of truth.